All right, guys. Thank you so much, those who are there. This is Prashant Kumar, and I'm your host. We meet once in 2 weeks. Hopefully, everybody can hear me okay. And today we have somebody, a great syndicator, capital aggregator, Lane Kawaoka. Lane, how do you pronounce your last name, sir?
Kawaoka.
Kawoka. Okay,
Very
very
close.
good. Okay. Yeah, I've known Lane for some time. I mean, we had touched base about maybe a year or two ago, but now we are rejuvenating our connection. And I asked Lane whether you would be able to come to my webinar or not, and he was gracious enough to accept it. Let me just tell a little bit about myself. I'm not going to bore you guys with my introduction because this is tonight is for Lane, and we will see how we can add value to this group, right? So again, of course, I am this is my company which you see on My Realty Gains, and that's what I do is just one second. My background is I have a strong technology background. My education was in technology, and I have done project management in global organizations worth 50 100 billion dollars, and all over the world. But in addition to that, I have a passion to invest in real estate. I own about 100 unit apartment complex in my 100 units in my personal portfolio. Besides that, I'm a GP in 1200 units. GP, LP. I mean, I'm not a sponsor today, but I have done sponsors for smaller deals and I have sold them double the investors' money. I have strong because of my technology background. I bring value by removing redundancies in and through meticulous underwriting, right? And I invest in multifamily. That's the purpose of this webinar. But I invest in assisted living facilities also. Last year I acquired three projects. This year we are working on three more. Hopefully, we can grow that portfolio also. But I have passion to mentor and willingness to share my knowledge with with my within my network. That's all I would like to say about myself. There's nothing more I want to say about myself, but I would like to introduce Lane now, who's going to talk, for some time, and he will share his valuable inputs with the group. Lane currently owns about 4,200 plus units across United States. He lives in Hawaii, so you see beautiful pictures behind him. He recently quit his day job. That was an announcement on Facebook or on social media. It's not recently, I think about a year ago, Lane, right? Maybe
Yeah,
more.
hard to remember. I think maybe 2 years. I can't
Yeah,
remember.
yeah,
It's been
it
just
is
too
more
long.
than a year. Yeah.
It
So
was another life at this
yeah,
point.
I kind of
Yeah,
remember, your
no more
post.
engineering job anymore.
That no more engineering job. Yes, but he's by profession he was an engineer. MS in civil engineering, construction management. So he has strong understanding about building and things like that. But he partners with his passion is his partners with investors who want to build their portfolio but are too busy to mess up with their tenants, toilets, and termites. By curating opportunities in his club, where his investors have personal access to him, know that Lane is personally putting his money on the line too, right? So his pipeline club, and I can't remember Hugh Deal Pipeline Club. That's what the name of his club is. Hugh Deal Pipeline Club. They have acquired $350 million worth of real estate by syndicating over $40 million of private equity since 2016. So in less than 4 years, they have $40 million worth of equity in $350 million worth of assets. I mean, I can talk about him for half an hour, but I don't want to steal the thunder. He has a great website, simplepassivecashflow.com. So guys, check him out there. But in the meantime, I'm gonna let Lane start talking, and let him talk for about 20, 30 minutes. And if you have questions in between, feel free to start you know you know putting those questions in the chat window, and I will ask him. But for first at least 30 minutes, let him talk. All right, Lane, all yours. uh, please continue.
Cool. Thanks for having me.
You are
So
very
I've got,
welcome.
I'm gonna be going through this presentation extremely fast.
Uh-huh.
Um, so I'm gonna glaze through a lot of this, but the topic of today that we're gonna get to is like, as an LP investor, how do you kind of do a little bit better due diligence? If you guys have any questions, feel free to put it into the question box. I don't see it, or the chat box, and I'll try and get to it. I can micromanage. So, it's a different world today with the pandemic world. To me, it makes no difference. My 4,200 units are cash flowing. At the worst of this, the percent
And as we get
collections were
started
maybe
soon,
down
very
to
quickly, I
like
want to share with you because I think if you stand for
chat.
nothing, you fall for
Thomas
anything. Core
Inman
business
maybe
values
can
that
go on
I
mute,
make my best effort to
please.
live by, and that we want our clients and students to.
Thank you. So normally we're at 97% collections. Through the worst of COVID, April, May, we went down to maybe the mid to lows. But the reason why we like multifamily is you don't become like Sonic the Hedgehog and lose all your coins. If you can stay above 60% occupancy in the right underwritten deal, you're still making money, you're still in the black. That's why we like real estate. Pretty good returns, but really good volatility. As Prashant has mentioned, this has changed a little bit. Currently, over $450 million worth of real estate. We have raised over $50 million within my group. A lot of doctors, lawyers, engineers, a lot of engineers, in fact. 4,200 units. If you guys like podcasts, check out my podcast, Simple Passive Cash Flow. Um, but yeah, a lot of people like it. Check out the testimonials. Here's my background. So you got to know some context where this stuff is coming from. I got a bachelor's of science industrial engineering from the University of Washington, and then for some strange reason, I thought to go get a master's. They tell you to go to school, get a good job, right? And that was how the way I got groomed growing up by parents who also went to college, living that same life. Uh, did a bunch of roles as a construction supervisor, then project engineer on the railroad, then became a city engineer for a couple years and started to build airports. But stuff about me personally, I am super cheap, or was very cheap in my 20s. Today I do things a little bit differently. But I take a shower at work, charge my Anchor battery at work before everybody had the Anchor batteries. It's a whole bunch of ways to be cheap and save money. So I could put money to these investments. And I grew up in Hawaii. I live here now. I moved back home, but I was in Seattle in 2009 where I started my investing. Bought a rental property, A-class rental, knew nothing about rental value ratios, knew nothing about not investing in primary markets like California, Washington, Hawaii. And but that's where I got the taste of cash flow. Right? I mean, $2,200 a month in rents and $1,600 mortgage. That was a lot of beer money to a young 20-year-old kid, and that's where I got the motivation to educate myself, as many of you guys are doing right here. And it took me a while to kind of get to this stage. Again, 2009 was my first rental. 2012, I went out of state for cash flow, started to pick up 11 single family home rentals. And around 2015, I got to a point where I was looking for the next thing, because I started to realize that having all these single family homes spread it across the country was not scalable. And it only at a few $100 of cash flow per property, I probably needed damn near 30 or 40 of these things. And it just wasn't practical. So that's where I kind of move more to being a syndication investor. And here's sort of my progression in terms of numbers, right? You just buy more properties throughout the years and your savings rate goes up, and you can use that to buy more properties. But somewhere along the road, you start to go into more scalable assets such as syndications. And I'm sure you guys know what a syndication is. I am a real estate syndicator. I sit in the cockpit. I put together these deals, and you know, we do all these things. We manage the manager. Our role is asset manager. We get attorneys, we get inspectors, we get brokers. We do all the work so people can sit and coach, sit down, cash their checks, and go to sleep. Just like how I do when I fly to the mainland to check out my deals. Just go to sleep for 8 hours. So you're just kind of getting into the LP education here, right? Like wide world of syndication, you can syndicate whatever you want, right? Multifamily apartment is a popular one that I like personally for many reasons, but you can syndicate a brewery, you can syndicate a tech startup. First thing you want to ask as an investor is, all right, are we working with a debt deal or is it equity deal? Now, debt deal is for those of you guys who have invested in a house flip, right? You're lending money to an operator, house flipper, to go and do a project, and they're going to pay you maybe 8%, 9%, 12%, depending how unsophisticated they are, or how much of a big risk they are. You may get more or less, but this isn't a great return. You don't get any of the upside, and it's ordinary income. Ordinary income is bad. Stay away from that. No good. Equity investors look for equity deals that you get upside. Trouble with the upside is you may have to wait a little bit to get your returns, but this is why I invest in equity deals. I want the upside, and I also want it in the form of passive income. So those you guys out there, this is what I do at my mastermind a lot. You know, deals is probably 1/3 of the picture, but most of it is family office advising. I mean, last year I paid no taxes. Many people don't pay taxes, not only on the gains that they make from their real estate, but talking globally. You're making a big salary at your job, yeah, no taxes, and there's a way to do this. For those of you guys who are looking to be sponsor syndicators, I give you guys the 2-part test. Are you good at being a landlord, doing all this heavy lifting stuff? Do you enjoy it? It's like, if you do it right, you're gonna be financially free in 5 years. Why the heck would you want to start doing something you don't enjoy? If you're like both of them, well, congratulations, buddy. I don't know what you're thinking. Just be a passive. I mean, this stuff is gonna be your life, being the sponsor, doing this stuff. Prashant knows this. All kinds of stories, right? Even on my single family homes, right? You deal with this type of stuff. This is on my YouTube channel where I did a walkthrough of like a tenant trashed my property.
Wow.
It's like $15,000 of repairs. Actually, I had 2 of these. I can't remember exactly which one this is from. One was 10 grand, one was 25 grand. But yeah, that's just how it goes when you're a rental property owner. And when you're a syndicator, you've got to deal with that. So I'm talking to high net worth investors. They're most of my clients, and this is kind of the rubric that I give to them. You know, when you're starting out, your net worth is under $500,000. Yeah, you got to buy single family homes because you can't really afford to go into syndication deals. Follow my progression on 2015. My net worth was at a point where it was decent, and I owned 11 rentals. But I realized scaling past 20 to 30 rentals just wasn't going to be realistic. And this is where a key thing happened for me. I started to actually stop being a freaking cheapo, and I started to invest my money in different masterminds, get around other high-paid professionals such as doctors, lawyers, engineers, who were 10, 20 years older than myself too. And that was where I found this world of syndications and private placements.
So I have a question here, Lane. Is you just said that you started paying money to get into those high-profile masterminds where these doctors and lawyers come around. I mean, is that the mastermind for investors, or is it the mastermind for doctors who want to be investors? Or how do you find those masterminds?
Well, masterminds for doctors. So doctors are traditionally, not to offend anyone, everybody giggles because doctors are horrible investors. And
Yeah,
a lot of those doctor groups are just really bad. Like, I mean, if you guys, I'm sure you guys are in some of them. They're like free Facebook groups. I mean, you pay for what you get.
yeah,
I can't say it more than that. You pay for what you get. Like, some of the worst places for us to go as passive high net worth investors are the local RIA.
yeah,
It's just wholesalers or flippers or people trying to make a first buck or get their net worth over $250,000. And then don't get me started on the free face or free online forums out there. You go on there, they're all wholesaling and flipping, super active investors.
mhm,
And look, if you don't make 80 grand or more at your day job, maybe you have to do that. But there's a lot of people out there that make pretty decent money and their highest and best use is at their day job.
yeah, yeah. Yeah, I mean,
So
see the challenge, I mean, I'm not talking about from a passive standpoint. I'm talking about from syndicator standpoint, where do you find these people? How do you get involved in their groups? Because if it is a doctor's group, they don't talk to anybody else, they are like up there. As you said, not to belittle anything, but they're not good investors, right? So they don't know how to communicate with them.
how
That's
do you
like,
get access to groups like that?
yeah.
I don't know. I mean, I just get referred to people like that.
Uh-huh.
And I think that the doors are closed for good reason,
Hmm.
right? To keep any random person out.
Yeah, yeah, that's true. All right, I'll let you continue.
So this is a little flowchart. I'm an engineer, so flowcharts are just kind of dictate whether you're more of a passive investor LP or maybe you should put in some sweat equity and do some deals, or maybe real estate's not for you. You need money to do real estate investing. If you don't have money, you got a money problem. So if you guys want to Google these charts and make this for yourself, it's called a Sankey diagram. Kind of cool.
Hmm.
But the secret is like making more money and spending less in the net, right? And that was my claim to fame. Like when I was first working, I was able to save 50 to 80 grand a year at from my day job. I actually didn't live anywhere for 3 years and I just lived on the company dime in hotels. That's the secret. Boom. But all right, let's talk a little bit more seriously about like passive investing in deals. There's a lot of ways you can passively invest. As we said, we're going to focus in on syndication investing. Here's kind of a chart that a lot of my investors like, where it's like on the y-axis, the left side, you got your kind of your percent of returns you can probably make in this, and the left side is the more lower risk stuff. The right is the higher risk stuff. So here's are all traditional things, right? These are like things that you can do better, right? Under this dotted line here. Stocks, bonds, mutual funds, REITs, lending money to friends and family. Ooh, we want this stuff. We want the goodies, right? And as an investor, you want to at least be in this side of the line and figure out where your risk reward profile, where your investment philosophy comes into place. And for a lot of people who are new to this stuff, you start off with the basic stuff like bonds, money market, and for those, I use the analogy of sushi. It's like we don't have too many sushi eaters in the crowd, I'm guessing, but it's just a good example. Good because if you're squeamish of raw fish, right? How do I get you to step up to the good stuff? Well, I give you a California roll. It's fake crab. It's not even crab. And then I give you like a shrimp tempura. And then I give you the spicy tuna. And if you guys have tried spicy tuna, most times people who give it to you don't tell you it's raw. You find out later. But then we step you up to the good stuff, right? And that's where the syndication deals come in. So I help a lot of people get turnkey rentals, get started, step them up to syndications, and then maybe to some exotic stuff. I know Prashant's kind of playing around with assisted living stuff. That's a little bit more on the exotic side, but you get there, right? This is all progression.
Hmm.
So we're going to go over 10 tips for being a limited partner, things to check out. These are by no means all encompassing. But one way is just understanding how the numbers work. If you guys want to go to this URL, you can download my simple analyzer here. Just kind of, you can put in the yellow inputs. It calculates the purple ones, and it kind of gives you what price what the property is worth. Very basic. And then also I have my more detailed analyzer for single family home rentals. Won't help you analyze larger deals, but you know, if you can break it down on a per unit basis, right? Like if a sponsor is buying a 350 unit at $25 million, you can go 25 divided by 350 and you get a price per unit. You can also find the average rents. You can start to put it in here to have some basis in reality. Again, that's all available for free. One of the biggest things to check as a passive investor is what is the operator using for assumed rent increases? Now, there's a whole bunch of data that they would likely pull from. Yardi Matrix is a great resource. I would say, I wouldn't feel comfortable anything above 2.5%, 3% rate increases per year as an assumption. I'll usually underwrite at 2% in a good market like Dallas or Huntsville, Alabama. And most times they won't tell you how much they're underwriting for, but you can probably look at, I mean, every deal sponsor pretty much uses this type of format, unless you're in a dumb doctor investor group where they don't show you this stuff because they'll just confuse people. Sorry, doctors. Hey, just being honest. But you can take the gross potential income. You can kind of see the difference between this one to this one, and you can interpolate the difference. So this minus this is the delta divided by this, and now you have your percent gain. So you can figure out if it's 2%, 2.5%, or 5%, which you don't want anyway. Number two, you can calculate the net, calculate your NOI, and you got to pick a cap rate. So just a little background, if people don't know this, you know, commercial real estate is often the net operating approach to find the valuation, as opposed to comparable sales, which is based on emotion. Ooh, we don't like that, right? We don't want emotion. That's like residential properties. We want net operating income. So some of the basics are your net operating income, which is your income minus all your expenses, minus your mortgage service, of course, divided by the cap rate. And that's magically the estimated property value. So working with big numbers here, the cap rate is super important, what is picked. And this is how like the magic of multifamily or just commercial real estate in general. I mean, if you can bump the rents up, I mean, you can create substantial value. Like, you know, property management bumped the rents up $45 across the board on 100 units at an 8 cap, that's $675,000 of value created right there. Or, you know, you add reserve parking at $10 a square or a space times 20 spaces at $300,000 of bumped value right there. So where I'm going with this, cap rate is super important. There's this thing called the reversion cap rate, which is exit cap rate. You want to make sure that the sponsor is using at least 0.5 point to a full point reversion cap rate. The reason why is because that exit cap rate is when you're going to exit the deal. We don't know what the heck the cap rate is going to be in the future. 3 to 5 years, we don't know. So what would we do when we don't know? We try and be conservative, and we try and assume that we're selling into a crappier market. So if you're buying a property at a 5.5 cap today, prevailing market cap rate, not particularly what that property is performing at, it's likely performing better, but the prevailing cap rate for that property in that submarket for that class, say, is a 5.5. Well, I would probably like to show it at a 6.5 for reversion cap rate, or 6.25. Something to check as an LP, because this cooks the numbers. I can show you whatever I want on my performa sheet based on, and by just changing a certain number on the spreadsheet. And this is probably the most important thing that I could change to cook the numbers however I want. So if I underwrote a property conservatively with a 1% reversion cap rate, say the deal returns 100% in return 5 years. But if I sharpened my pencil and did only a 0.5% reversion cap rate, now that turns into 129% return in 5 years. What's dangerous is when you got a deal that is showing like it's 85% return in 5 years, but they're using a very slim reversion cap rate. So when you fatten that reversion cap rate, make it more conservative, that 85% return goes down to 40, 50% return. And to me, that's not enough buffer in there. It's always good. Sometimes the sponsors will put in a sensitivity analysis chart in there, and that helps makes the math for you a little easier. And that's what these things kind of show right here. So here's kind of a picture that I did. You know, you're buying at a 4 cap, and this, if you're assuming that your exit cap rate is at a 4, this is what happens when you hit the 5% reversion cap rate. That's why you try and assume that it is higher, so you don't get jacked up like that train. You don't get railroaded. What are typical terms for lending? This is a little old, but yeah, a little bit below, maybe 2.9 is kind of the lowest I've seen recently. Fannie Mae, Freddie Mac, loan to values. You get better loan to values in tier 1 markets, which are like San Francisco, New York. But you wouldn't invest there, right? Because there's no cash flow there. Whereas like tertiary markets, they're not, they're more tier 3 markets. And you can Google this on Fannie Mae, Freddie Mac, and it kind of changes over time. But they're kind of going less than 80%, probably like 70, 75%. 25, 30-year amortizations. But this is the big one up to, you know, it's the term length. And you want to have a term length that is at least longer than 10 years, I would say. The reason why is, you know, as we know, market cycles go up and down, and you don't want to be forced to sell or refinance in a trough. So you want to go into a deal knowing that if a trough does come, crappy market does come, that this term can sort of bridge you over that gap, right? So if the bad times come, it's like that. And this 8, 10, 12-year one can bridge you over the gap. Too often, like mom and pop investors get these like crappy 5-year terms, and that'll just land you in where you don't want to be. Interest only sounds cool, and it is cool, but it does skew IRR on projections a little bit. And I don't want to get too much into it because it's a little bit more of an advanced topic, but the prepayment penalties is a big thing. Not a lot of sponsors account for it in their deals. And although what we'll usually do is like, yeah, we can get a 15-year term, which, you know, what I just said is more better, but at what cost, right? Because if you do a 15-year term, you might have heavy prepayment penalties. So what we'll do a lot of times is go to a shorter term length. 12 years is just as good, in my opinion, as a 15. So that we can kind of buy down that prepayment penalty. We'll go switch to more of a hybrid loan, and where we don't have the prepayment penalty, but maybe we're paying a little bit higher interest rate. So I think a lot of LPs, that probably just goes over your head, but just know that when you're kind of looking at a deal, it's not just about the term length, it's not just about the interest rates, it's a little bit more bigger picture than that. Smaller deals have a little bit more risk, so interest rates are a little bit higher. And let's talk about tax stuff. Like, how do I pay like no taxes, right? To me, Trump messed up. I don't know what he did. Paid $750. Probably had a minor oversight. I don't know how he was personally, but I'm guessing he probably yelled at somebody. Why? How did I pay $750? But yeah, so these larger deals, I mean, any real estate, you can do a cost segregation. So cost segregation, you send a geeky engineer out there with his clipboard, just making this story up, but just creates a story. And he breaks down all the major components of the building and creates an amortization schedule, and it gets itemized on a 5, 3, 7-year time horizon. And currently, the way the tax rules are written, should you go through this exercise, you can deduct about a third of the building value in year 1. Again, as a LP, this probably just goes over your head. Doesn't matter. You go into a deal, they have good leverage, they're doing a cost segregation. I'm seeing some of my investors get 60%, even over 100% of what they get back. So they put in 100 grand, they get maybe 60 grand to 100 grand of losses on their first year. And they can use those losses, they just stick it in their back pocket and use it strategically when they want. And this is what I work with my clients on. It's like, how do we bring this into your own family office to pay less taxes? I'm not a CPA, but I don't got a job like CPAs, put it that way. And I don't pay very much taxes, but the CPA's job is to do the forms. To me, they're not really there for strategy. That's your job as the investor. I'm not a big fan of 1031 exchanges either, especially when you go into these deals and you're getting so much passive losses. If you sell anything, you should just have all this passive losses banked up to offset that capital gain and depreciation recapture. But yeah, I work with a lot of my clients. We kind of look at where they fall AGI wise and kind of strategize on what's the best deployment schedule, what deals to go into. Here's my 2016 taxes, paid 23%. This is before I was just a rental property owner at this point. And 2018 started to invest in deals. My tax rate was 4.2%. And this year, boom, 0%. I know some people think I'm a jerk, but look, I'm the one putting all this money into the economy, funding deals and making this economy work. To me, if you're not doing that, well, that's what you got to pay taxes for. If you guys want to check out my tax guide, it's simplepassivecashflow.com/tax. I'm sure you guys talk about this a lot, but not every deal is the same. In fact, it's very hard to make it like compare different deals. So it's important to kind of, when you look at a deal, all right, what property class is the A, B, C, D, and what kind of neighborhood class it is, A, B, C, D. A class is pretty safe. A young gal could probably go running at night. Class B, probably she doesn't want to do that. Class C, I don't even want to be out there during the daytime. That's kind of my loose barometer. But I tell investors, yeah, just come and walk properties with us, and that way we can kind of calibrate on actually getting the vibe. I mean, that's why I visit properties, because it's just getting a vibe of things. And then that's why our plan is to invest in more class B and C housing, because in a recession, this bell curve American population kind of moves downward, and we can catch the people coming from the luxury and B class stuff. If you guys are new to real estate investing, I would go check out a book by Gary Keller, Millionaire Real Estate Investor. He's got this figure in here. It's just, that just says a gazillion words right there. If you guys want to take a screenshot.
Can we just discuss this for a second? What is it doing? What is it?
Yeah, so a lot of things going on here. People, what it's basically saying is that there's a sweet spot in terms of buying crappy, like class D properties. You don't want to go too low end, and you don't want to go too high end, right? You don't want to go A class. This is why we stay in the middle. Workforce housing is class B and C.
So why do all these high class syndicators, they are starting to go towards A class properties? I'm seeing bunch of syndicators lately going towards A for whatever reason. I don't know why.
Well, I mean, acquisition fees, big payday when you close a deal, right? On one of those like $20 million deals.
Yeah.
I mean, I personally am trying to stay away from class C deals personally, because they're a pain in the butt. Like tenants, they don't have much savings accounts.
Yeah.
But I mean, every deal is different. That's why you have to dig into the P&Ls and rent rolls. And quite frankly, LPs don't have a clue how to do that. So which makes this extremely hard to do, which is why I say, unless you're going to be an underwriting specialist, the best thing you can do is to build your network, with like what you guys are doing here, and building relationships with other people so you can invest via proxy, right? Make real friendships.
Yeah.
And ask what they're investing in, who is stay away from. Simple.
Your network is your net worth. I mean, I think that is the most important slogan that we have in real estate. Your network is your
Exactly.
net worth.
exactly. And if you're doing the cheap, easy, free method, you're paying for nothing. Yeah, you're gonna get a crappy network. You're just gonna get a bunch of cheapos in there too.
Yeah.
I was one, and I'm recovering cheapos, so I could say it.
Yep. Yeah.
I see it a lot of times. So going from single family homes to syndications, for those of you guys who are direct property owners, it's kind of like going from you guys are, I'm a basketball fan. I like LeBron James because we're the same age. But yeah, I mean, do you skip college and go straight to the pros? And what separates LeBron James from Lenny Cook there on the right? Definitely not winning any NBA championships. When do you jump to the big leagues, right? When do you go from single family homes to syndications? I have an article on this at simplepassivecashflow.com/syndications where there's this little graph here.
Mhm.
But for the most part, yeah, if your net worth is under $250,000, I would say stick to the small stuff. Or you have to put in sweat equity. Kind of getting to the end of here. If you guys have any questions, put in the chat. But here's just some random things that I see a lot of unsophisticated investors make as mistakes. So they focus on the general partner LP split or the pref. They're like, oh, that's a 70-30% split. That's not good. This one's 80-20. It's like, dude, that has nothing to do with anything. Look at the deal assumptions. Look at the deal. Who cares if it's a 95-5 split? If the deal sucks, it's going to tank anyway. Number two here, cap rate gate. This is using the right reversion cap rate. You don't want to be like that train that got smacked because it didn't assume for cap rate expansion. Check the comps. What are the other like properties renting for? And this is hard to do remotely. The best way, and this is what I always do when I go to a town and check the property, I also check out the comps. I look like I'm like 25 years old, so I actually can go in my hoodie and like go and like pose as a tenant. Not saying that that's practical for people to do, but that's what you should be doing as an LP because all the stuff is based on the comps. What are those other comparable properties renting for? They don't dig into the pro forma return on investment. They just take hey, they said they're gonna double my money in 5 years. That means nothing. They can do whatever they want by putting the right numbers in there. They invested well, they don't know, like, or trust. Like we said, build your network. That's why I did it. You don't want to be like me. I lost 40 grand in my first LP role. I just invested with the wrong person, and it was through a random referral. You can read more about that debacle, but yeah, I think these syndication deals are better. They're stronger deals, but you just got to mitigate investing with a shyster. Yeah, and I think this is the way to go. This is why I invested in over like 20, 30 deals myself. You give up some control, but you get back diversification by different needs, different partners, asset classes, mobile home parks, self-storage, mobile homes. I'm 80% multifamily apartments personally, different geographic areas, different business plans. And people don't flex their equity. They just buy properties and never sell. I think that's a really bad idea. You got to keep it rolling. You got to get that equity moving, like in this diagram right here. Find your lazy equity, right? And this is what the syndications do, right? Once they do the value add, they sell, they get out, and you move it to 2 deals. None of this lazy money not doing anything. So some overall holistic wealth building stuff. This is what I personally like more than operating deals. Is like kind of advising people on strategy for their own family office. It's not about getting your 15%, 20% IRRs multifamily, but it's about re-leveraging the lazy equity you have in your portfolio. Because when I do a deep dive at a coaching call with a client, I'm likely like a lot of like half of their money is not doing jack. And that's the stuff that we have to work on. That's these guys right here. Implementing infinite banking. I'm a big proponent of that, especially if your net worth is over $1 million. Getting retirement funds out of that qualified retirement scheme. I don't like retirement funds at all. No Roths, no QRPs, no IRAs. getting your asset protection sized right, and then get you on that simple passive cash flow gravy train where optimizing taxes, getting passive loss to offset active ordinary income. Here's kind of my personal portfolio and how it's all split up. And yeah, that's what I'm up to these days is just finding good class VC properties, putting a little value add and collecting the cash flow as that happens and then selling. And yeah, that's my way of wealth building is being like Vitrio, a little bit singles here and just going into good deals. Here's kind of like my ideal portfolio or how someone should start off with a bunch of rentals, layer on top of your syndications, then do something a little more exotic. And I get out of the rat race. And get to a point where you can hit critical mass.
How many years did it take for you to get out of your rat race lane?
I think the year I quit was 2018 or 19. Can't remember. But I started investing, bought my first rental in 2009.
Okay.
And I had about in 2015, I had 11 rentals. So what people don't realize is it took like a decade to do.
Yeah.
And I was powering at like I was putting away like on average maybe 50 grand to savings every year to put to more investments.
So if one has to I mean, what is one thing that you would like to tell your listeners in terms of those who want to get out of rat race? What should they do and what should there be time frame?
I mean, many things, but it's all based on their personal situation, right? If are we talking about a broke guy who has no job?
No,
Oh,
no,
I'm
I'm
sorry, I
talking.
can't help you.
You
But
know, I'm
if
talking
you're
about
a
somebody.
if you're a
Somebody.
high paid working professional making over 100 grand a year and you're able to save 20 grand a year, all right, cool, we can work with that. If your net worth is under 500,000, well, maybe go buy a rental property to learn this a little bit. But
Mhm.
then if your net worth, once your net worth gets over 500,000, yeah, syndication deals and the simple passive cash flow gravy train, we're paying no taxes.
Mhm.
Yeah, I mean, it's all math, right? Like if you're putting away in this case, people can download this calculator at simplepassivecashflow.com/legacy.
Mhm.
But if you're able to save maybe not 50 grand like how I was able to do when I was single, but like 30 grand a year, and you're able to grow your money at 5, 10, 15%, like this is how your net worth grows. And it's
Yeah.
just exponential growth. But yeah, anybody have any questions or comments? Cool. If you guys want to get a hold of me, shoot me an email at Lane at Simple Passive Cash Flow. But yeah, thanks for having me.
No, very good, Lane. This was great, and this is a great presentation. But I think, yeah, the presentation looks very good. People want to know what is the real success. What is deep inside. What do you attribute to to your real success? What is the real thing? Give something meaningful to the listeners.
Find the right plan. Like, I mean, I kind of just outlined a little plan right there,
Hmm.
but find out and execute. Very little people execute in this world.
Hmm.
I spend too much time screwing around on social media. Um, to me, it's like if you're a working professional, you just have to be investing, and you'll get there in under 10 years. It's not that hard. It's simple.
Yeah, I think under 10 years is easy. I think anywhere from 5 to 7 years is an optimal time frame. Because I mean, I recently started. I mean, I'm a little bit behind, but I recently started 4 years ago, and I was able to put in 1,200 units last year in total. I mean, I make good money in my job. I mean, I haven't quit my job. I thought of quitting, but still haven't come out of it. But I mean, I have 1,200 units. I have 100 units in my portfolio, and I'm adding constantly new properties in my portfolio. And I mean, maybe 6 months, maybe a year down the line, I would be ready to quit. That's.
Yeah, and I think everybody should, if you're making over 100 grand a year, hold on to that day job for as long as you can.
Mhm.
I mean, I mean, it allows you to kind of be very lean with your time and be very efficient so that when you do quit your job, I mean, you have the systems in place. And this is a money intensive business. I mean, this is investing. We're not creating startups out of nothing. So you need that cash, that income stream behind you.
Yeah, and it takes time for you to build your network. I mean, it takes time for folks to start trusting you. I mean, nobody trusts a rookie like me when I was in the beginning, but now we have. I mean, at least I have some network where people are willing to invest with me
Yeah.
or the deals where I'm able to fund. So the other question that we have is, are you a sponsor only, or are you a sponsor as well as capital aggregator for others deals?
I am a sponsor and operator.
Okay.
To raise capital is illegal, in my opinion,
Mm-hmm.
where I read SEC.
Mm-hmm. So you do not help others I mean, other sponsors project in terms of equity, basically bringing equity to the table.
No, no,
Okay.
I've stayed away from that. It's a great way to get the SEC knocking on your door.
Got it. Got it. So, what kind of team do you have? I mean, I know you are in Hawaii, and I mean, do you travel to the United States, or do you come here? You have, I mean, I'm sure you have students all across, those who probably are your boots on the ground, depending upon where you have the deals. But
Well, my students are all passive investors.
okay.
And it's very separate. It's a different business unit than my operations side. But on my operations side, it's me and some support staff. I'm I mean, like I tell investors, I'm the principal. I don't have like a director's operation Western Hemisphere, which is why I don't need to pay like some of these deals, they have like 3, 4, 5, 6% acquisition fees. I don't need to do that. I don't have all this staff, this bloated staff. Um, and that's just how I wanted to run my business. I don't need to grow to be that big. I want it to be more boutique.
Mhm. So, and so in your operations, what kind of staff do you have? I mean, what kind of folks typically? I mean, just a very general question.
Um, Definitely got like the cheap VA staff for
Mhm.
sure.
Okay.
Um, that you can get at like you get it as low as $4 an hour, but again, that's still a cheap, easy, free mentality. Like try and get like a halfway decent one at like 5 to 6.
Yeah.
Um, pay people a little bit more than they want. It's
Yeah.
kind of a general rule.
Hmm.
Um, but then also have some more higher level staff too
Hmm.
on top of that. But it's I don't know. I am definitely hiring more people, and it's like I put an ad out on Indeed.com and like admin assistants, they want like to be paid like 25, $30 an hour. Like, do you guys
No.
know what better employees in the Philippines or wherever charge for the same, better service or better value?
Hmm.
It's ridiculous.
Yeah. No, that's correct. I mean, I know there are a bunch of people who have a lot of VAs across the other side of the world. They try to keep their costs down. Um, you know, uh, but I mean, in this business, it is very challenging to keep the cost as little as possible, because syndicators, in my mind, syndicators do not make enough money until they exit the deal. Right? Initially, you have, yes, a little bit of uh, acquisition cost and stuff, but during the deal, we hardly make any money. Which is,
Yeah.
unless you have constant deal flow, constantly new deals coming, is very hard to keep up. It's only when you start exiting the deals, which is 2 3 years down the line, a lot of hard work. That's my thought right now, and maybe you have a different thought on that. At least for 3 years, you don't get paid enough.
Yeah. And that's why like I was mentioning earlier, like some new unsophisticated investor will look at like the split scheme and be like, ooh, if it's more than 80, 20%, that's too rich for the general partnership. But I look at the opposite. I like exactly to your point. Like, what kind of decent sponsor that has a track record that will work for less than a 70-30 split? You
Mhm.
know, like, all right, man. Well, go ahead and invest in that deal. Good luck, buddy. But like, and it just it's not worth the effort, right? It's like rather go to your day job. Who cares about this stupid investment on these cheapskate investors at a
Right.
certain point, right?
Right.
Like,
No.
it's just economics. The people and syndicators, they should earn a certain price.
Yeah.
I
Yeah.
mean, that's the economy. If they're creating the value, right?
Yeah.
They're if they're more than exceeding the best alternative that the investor has to get their grow their money safely.
Interesting. No, very, very interesting. I would like to say just one more thing before we kind of move to the next thing. Um, uh, just 1 second. I mean, because I also have I also have a portal sort of thing. The name of my company is myrealtygains.com, and I have created a small course for my investors. 7-day email course. And that's just same education. I mean, and it's just a bunch of videos that you get every day through myrealtygains.com. And I have created a passionate passive investors club. I call it PPIC, and I will post this in the chat window for everybody. Basically, myrealtygains.com/PPIC. Uh, Nothing spectacular, but it gives everybody some education about what Lane has been talking about. I mean, by no means I'm in comparison to him, but feel free, guys, to check it out. Join PPIC if you want to. You will have free membership, like everybody else. Like Lane shared his website. So that's something. It's a lot of work. I mean, I know, Lane. You have bunch of things in your on your portal. Even to create this was a lot of work for me. Um, you know, of course, I did it with my full time job. Uh, but yeah, I mean, one other thing I'm looking myself in my business is assisted living. I typically has passion to help elders, so that is something which kind of struck me in my life, and that's why I started helping. Started going into assisted living also. I like senior people just because how I was raised. So I we are into few projects last year, and we are getting into few projects this year, the smaller projects. Like in California, they have 6-bed facilities. The cash flow is a little higher there. I'm just sharing that. I mean, those are non-syndicated deals at all. I mean, there's no syndication involved there. We just buy those businesses. So this is my 2 cents in the end of this webinar. Do we have any more questions today? Guys, if you want to come online, show your face, you have few minutes, 5-10 minutes, I think. Talk, questions, network with us. Feel free to do so. Um, hey, Nara, how are you?
Good, good, brother. How are you?
Very good, very good. Thanks for joining. Good to see you.
Yep, same here. Thanks for
And
the organizing, and it was great pleasure to learn from experts.
yes, indeed. Very welcome. So anybody else wants to come on camera, maybe network a little bit, get to know Lane a little bit more? People are not so much interested today, but that's okay. Sometimes, people have, sometimes, we are 20, 30 people, I don't know, for whatever reason, uh, we are not that many, but that's okay. It will go on
Yeah.
Facebook, and it is live on Facebook. It will be on YouTube and stuff like that. There will be recording that will be sent out to everybody. So any questions, any other questions for Lane today, guys?
Yeah. So Prashant, I have one question. So
Sure.
Lane, help me understand, what does it took you to break down from being, controlling as a, single family home investor to, syndication? What was it like, the mindset and the
Yeah,
thought
you
process?
have rentals now, or
Yeah, I got couples, eh?
yeah. So in 2015, I had 11 of those annoying
Mhm.
buggers, and I'm sure you can kind of get a sense for this. Like, 11 is a pretty decent sample size, right?
Yeah.
I had an eviction or two every year, so like one every 6 months, right?
Mhm.
And some kind of big issue or catastrophe that happened every quarter, right?
Mhm.
Not I guess not a catastrophe, but like a toilet breaks, a tree falls on the
Yeah,
house in a
yeah,
storm, something. We got property managers, right? We're not dummies.
yeah.
We don't do this stuff ourselves. So it's about emailing that the property manager. So it's not that hard. But oh, I just saw your Honolulu cookie company. Sure. But so at like 11 rentals is that much work, which isn't that hard. And if that is what, $300 per property of cash flow, that's what, $3,000. That's whoop-de-doo. Like, that ain't good. And that's great. I was happy for that, when I was in my early 20s. But what American family can live off of that, right? You're gonna need damn near 30 houses, 40 houses, and then you're gonna need, multiply all that by 3 or 4. So an eviction every other month, some kind of big catastrophe every couple of weeks, just becomes a job. And as we all know, right, like, if I kind of glaze over the slides, like the returns, right? When you first are going into property, your returns are pretty high, right? Like, there's this thing I show a lot of people, right? Like, you're making like 30% on your money, and then as time goes by, your property appreciates. You're paying down your mortgage, so your return on equity goes down to here. A lot of people own the homes outright. It's the dumbest thing. That's stupid, because like your return on equity is jacked. It's like less than 5% for all that headache and liability. What you need to do is sell the asset or refinance it and get this thing back up. And that's when you're talking like 30 properties, it's impossible. Impossible to do.
Take more time.
I
I
mean,
mean,
is there any reason why you would want to own single family homes or do it yourself? That's my question.
Well, I think that's what I was trying to. It's a mindset and it's a control issue, all right?
I
So,
hear you, man. I mean, I thought the same way. I fought it tooth and nail. I was like, damn it, I don't trust nobody. I was the same way. But
well, I'll
it'll
share.
happen. You just gotta surround yourself with the people who are doing it too.
Well, I'll share
okay.
my story here. I have three single families, and I spend more time worrying about those three than my 100 units. Because my 100 units, I hardly lift my finger, and that's like easy cash flow. Property manager is managing that. You are talking once a week or once a month. But these three single families, every other day there is some problem. My tenant has not paid me for last maybe 4 months in New York. I cannot do shit about it, and he's not going to pay me for next 4 months. That I know for sure. And I cannot evict. I cannot, what I mean. So what it is worth? I mean, is it worth my attention, worth my time, worth losing sleep over one single family on which I was making only $200 a month, and at the end of the day, it will be all gone, right? So that's my 2 cents for single family versus multifamily.
I've got a couple other points to add on. Like, number one, the taxes. You- You're getting these manini little like depreciation with like single family homes when you don't do the cost segs. Just get way more losses that you can play all these tax gains and pay no taxes with. Second of all, like, when you're on the small scale, you're competing with so many unsophisticated investors,
Yeah.
right? When we go after these properties that are 100 units and above, we're also staying below the institutional guys, right? The guys investing people's retirement monies for 5%. Like there's this kind of bubble we stay in sweet spot where you're above all the unsophisticated mom and pop investors who buy the 4 unit, the 8 unit, the 16, the 32 plex, the 50 plex, and we stay above those guys. I love those guys because we eventually buy the properties when we screw it up, and they're. I mean, nothing about old people, but
Yeah,
I wouldn't want them. Like, if you can't use the internet, sorry, dude, you can't asset manage these days.
that's correct. No, that's correct. I mean, that's really true. I mean, there are guys in this world. When I bought my 72 units, and I said, rent roll, can you please send me the rent roll? He will send me FedEx. I said, I don't need FedEx. I said, send me an email. You know what I mean? There are people like that in this world. You ask for some information, they will, okay, I will get it printed and send it to you by FedEx. I said, why can't you just send it to me by email?
Sounds like opportunity to me.
Yeah, it was an opportunity for me. I bought that property from him. I said, I did not waste a single day. I said, let's buy this. You know. No, Lane, thank you so much. I appreciate your time. I truly do. And